Now's the part of the show where I talk about what I believe individual investors, all of you, should be focused on before you make your investment decisions over the next, let's call it 5 to 10 business days. Here we are once again talking about Fed speak. And yes, we've had this on our list many times, kind of went away from it for a little bit there, and now it's back at the top of our list. What is the Federal Reserve saying? What is Jerome Powell saying? He was actually being interviewed this morning. I saw his interview with some of the other areas of the world or countries of the world, like the head of the Bank of England. I saw head of Bank of Japan was there. ECB was there as well. And obviously Jerome Powell representing the United States and the Fed. What did Jerome Powell say? That affected the markets even as most recent as this morning. But what did he say last week when he testified up on the Hill in front of Congress? What did he say about the markets and where interest rates are going? Second thing I think individual investors need to focus on is market valuation. And we've had this on our list, but maybe not market valuation with respect to the whole market. I want to focus on the tech sector specifically. We've been hearing the word bubble pop up recently. Is this true? Are we in a bit of a tech bubble right now? And lastly, or the third point, let's focus on the positivity amongst or in the midst of all this negativity. There are a lot of negative data out there and information out there, but there's a lot of positive as well. And I think before you make your investment decisions, you need to take a step back and focus on the positivity, not as much on the negativity. So let's get to the first topic, which is Fed speak. And as I said, Jerome Powell, let's say last week, spoke in front of Congress, and he surprised the markets. Why did he surprise the markets? Because he said we could see as many as 2 more rate increases in the United States before the end of the year. He said that the how quick they raise isn't as important as raising itself. And the market, in my opinion, had priced in pretty much the fact that the Fed would be at the end of the interest rate hiking cycle by the summer. And when he said that we could see a rate increase in July, maybe another one in the fall, that took the market by surprise, and the market reacted negatively. We saw the first negative week for the NASDAQ, for example. We saw another negative week for the Dow Jones, and the TSX didn't fare too well as well, based on this notion that rate hikes were not over and that we could see even a higher Fed funds interest rate coming up, I guess, over the next 6 months. We have a few charts here that I think are really good to point out. The first one is the U.S. Consumer Price Index. This shows us where we sit right now with the inflation rate in the U.S. And obviously, the Federal Reserve is raising interest rates to combat inflation, to bring it down. You could see that inflation has now fallen to 4% in the U.S., down from 9% about a year and a half or so ago. And you can see that the core rate of inflation is still stubbornly high at 5.3%. What is the core rate? Well, it is the rate of inflation once you strip out volatile food and energy or oil prices. And that is really what the Fed is focusing on, this core inflation. And as I've said many times on our show, it's the core that's most important. And what has brought down the rate of inflation, in my opinion, has been the low energy costs, people coming back into the labor force. These things have been more important. Also, the supply chains, the bottleneck, that's pretty much disappeared now. We're now getting goods shipped all over the world a lot more freely. So these things have done a lot to bring down the rate of inflation, not so much or not as much this rise in interest rates, but the Fed seems to think they need to continue to do this. The next chart that we can show here, which shows the federal funds target rate since 2006. You can see how high interest rates have spiked back to 2006, 2007 levels. You're looking at a 5.25% rate, obviously much higher than the inflation rate in the US, which is 4%. Usually once that target rate by the Fed is above the inflation rate, the Fed, you would think, would stop raising rates. Not the case, because core is still 5.3%. But you can see what a spike we're seeing with that rate there. And next chart we've shown many times, shows all the interest rate increases by the U.S. Federal Reserve. And again, we focus on the Federal Reserve even more so than the Bank of Canada, because this is a show where we talk about the stock market, where we talk about investing. And the investment markets tend to follow the Federal Reserve a lot more than they follow the Bank of Canada. However, because we are living in Ontario, in Canada, many of us in Toronto, I want to show the Bank of Canada's overnight interest rate versus the inflation rate to end off our illustrations here. And you could clearly see how much inflation has come down in our country. We just got a reading the other day, brought us down to 3.4% on the inflation rate. We have a Bank of Canada rate, a bank rate of well over 4%, almost 4.75. There's talk that the Bank of Canada could raise rates again coming up in July. If they do that, that would take more than likely our prime rate. So the prime rate is the rate that the banks provide all of us that want to borrow from the banks, well over 7%. Right now it's 6.95. Prime rate could go to 7.2%, a rate we have not seen in many, many years. So you can clearly see that interest rates are on the rise. And even though Federal Reserve looks to be or leaning towards more of a hike coming down the road, we need to keep an eye on that. We need to keep an eye on that if we're going to make good investment decisions. Second topic that I had on our list with respect to what I believe individual investors should focus on are market valuations, and in particular, tech stocks. To me, all I've been hearing is about how tech stocks are doing so well. And many people have been talking about this idea of a tech bubble, that perhaps artificial intelligence are leading us towards a tech bubble that will possibly burst, very similar to what we saw back in the late 90s. And I have a few charts. Some of them we've seen in the past. Our first chart here is NVIDIA. You can see how much NVIDIA has gone up. We've had this chart up many times. I think NVIDIA had a high of somewhere around $430 not too long ago, back down towards that 410, 414 mark. Broadcom, a chart of our stock, another chip company, semiconductor. You can see how well Broadcom, and the slope of that curve is even steeper than NVIDIA, which is quite amazing as well. And I guess the last chart I have here is a chart for an ETF on artificial intelligence, or what we call robotics. And it's an ETF that shows how well all these companies that are in this ETF or in this index have done. And you could see if you own the ETF, you'd be doing fantastic. You would have probably made somewhere around 60% return in a very short period of time. And that has caused many people to talk about valuation, talk about how this part of the market could be in a bubble. So the one comment I'll make about that is, I don't like trying to figure out whether it's a bubble or not, but keep in mind, this is not like what we saw in the late 1990s. Back then I was a new investment advisor, just came out of advisor school. So, I've been doing this now for over 25 years. So I was in the first few years that I was out into the investment world, helping individuals with their portfolios. And what I was getting are calls to buy these .com companies, bid.com or this.com or that.com. Most of these companies had no earnings. Most of these companies were built on really no foundation at all, a house of cards, basically. And once you remove a card from the bottom of that house, what happens? The house comes tumbling down. And we saw that in the late 90s. Unfortunately, it took down, or that tech bubble bursting, unfortunately took down one of our biggest companies in our country, Nortel, if many of you remember that. But this is nothing like that. The companies that make up the Magnificent Seven, or a lot of the companies that have moved higher based on this idea of artificial intelligence, they have earnings. They have a lot of earnings. These are some of the largest companies in the world: the Apples, the Microsofts, the NVIDIAs, the Googles, the Metas, et cetera, et cetera. These aren't companies that just rely on artificial intelligence. They're relying on artificial intelligence to make what they do even better. Amazon is another name that comes to mind using artificial intelligence. And they've been using AI for quite some time. So please don't get caught up in this hype about bubbles bursting and tech bubbles bursting. I just don't see it right now. To me, these companies will continue to move higher. How fast and at what rate is the question. Right now, some of them are stretched. Some of their earnings have yet to match how fast the stock price has moved higher. So perhaps you want to maybe take a break from some of those names and move into some of the names that are a little cheaper. But overall, I think market valuations for many names are actually pretty good, and you should consider owning them if you're looking for growth names. The third topic and last topic that I have for all of us to consider before we make our individual investments over the next couple of weeks is this idea of focusing on the positive. There are a lot of negative points out there right now. Higher inflation, higher interest rates. Most of us are seeing the interest we're paying on our mortgages skyrocket, up 30%. We're seeing price of groceries up 9% in Canada. These are things that are obviously eating away at the income that we bring into our households. A lot of negativity there, and a lot of people don't see that getting better, even though we're seeing the headline inflation number come down. But I think for stock market purposes and for investment purposes, we need to focus on the positive. What are the positives? Well, a resilient economy. We're seeing the economy still showing positive growth. By now, most of us, or most investors, or most analysts, economists, thought we would already be in a recession, and we're not. We're also seeing retail sales numbers hanging in there, positive numbers. In Canada, we're seeing retail sales numbers better than most of the G7 nations. Even in the United States, we're seeing positive numbers on retail sales. The economy continues to move forward, even in the face of adversity, even in the face of higher interest rates and higher inflation. And to me, that is what we need to focus on. So before you go make your investment decisions, focus on the positive. Don't let the negative get you down. And a chart we have here, just a simple chart of the S&P 500, clearly shows you that if everything was so doom and gloom, how would the S&P 500 be up 14% year to date just after 6 months? So continue to focus on the positive. Try and stay away from the negative, even though it may be all over the place in the media, on social media, throughout the internet. Focus on the positive. Focus on the glass being half full, and focus on what you can do with your money and where you can invest it to get most bang for your buck.